Well, good morning. We're going to go ahead and get started now. I see we've got a number of people who've signed in, and there'll probably be a few more joining us, but that's okay. We're going to go ahead, and again, we want to make sure we get this done on time. I'd like to welcome you all to our webinar today on why you're overpaying your business property tax. We're going to take an overview of the Form 571L, your business property statement, how it's taxed, and why you could be overpaying. But before we get to the meat of our webinar today, I do want to do a little housekeeping here. Everybody on the call is going to go ahead and be muted. We do have quite a few people that are on the call today, so we're going to keep everybody muted just to keep the background noise down to a minimum. We're going to try and get this done in about 22, 23 minutes, and then we're going to open it up for questions. We'll have a good Q&A session at the end of that. So as we're going along, again, we're going to try and get through the meat of the webinar, and we're not going to try and stop only because I want to be respectful of your time and I want to get the information out to you and get you back to your normal daily routines. But if you do have questions, there's a little chat box there on your right on your control panel. If you go ahead and type your questions in, our moderator, Cowboy Keith Jenkins, is going to keep track of those questions for us, and we will open it up at the end of the webinar, and we'll get answers for those. I'd like to introduce the moderators on the call. My name is Rob Burden. I'm the Vice President of Sales and Client Development here for Paramount Property Tax Appeal. Prior to getting into the business development arena, I started my career with the Big 8 accounting firm of PricewaterhouseCoopers. I spent the first 7 years of my career there. I then left and went and was controller of an international manufacturing company based here in San Diego with operations around the world. I did leave there after that and spent quite a bit of time in commercial real estate, so prior to coming on board with Paramount Property Tax Appeal. I'd also like to introduce Tom Bergeson, and Tom is our Chief Technical Accountant here and handles all of our appeals and the audit division for us. Tom spent 27 years as a lead auditor in the Business Property Tax Division for the county of the San Diego County Assessor's Office, and we are very, very lucky to have Tom as part of our group. Again, he brings almost 30 years of knowledge of business property taxes. He wrote the manual, he knows the code inside and out, and he's an invaluable resource not only to us but to our clients as well. And lastly, I'd like to introduce Cowboy Keith Jenkins. He's our Director of Marketing, and he is going to be assisting us today in moderating the call and writing down your questions as they go along, and we'll have Keith bring those on once we get started. So let's get to it. Okay, real quick, for those of you that are new, we have some new people on. We invited quite a few people. Just want to give you real quickly who Paramount Property Tax Appeal is. Paramount Property Tax Appeal, we are a consulting firm that focuses on helping companies throughout the western United States reduce their annual property tax liabilities, that's on your buildings, etc., as well as on their annual business property tax liabilities. Those are the two focuses of our business. Obviously, today we are just going to focus on the business property tax liabilities, and we'll have another webinar another day to talk about straight property tax liabilities. What's the depth of our practice? Well, we've handled over 10,000 appeal cases, both on the real property and on the business property tax side, and this has resulted in over $500 million in reductions in assessed values and over $7 million being returned to businesses, business owners, and taxpayers. Okay, the meat of our webinar today. What is a Form 571L? Well, the 571L is your business property tax statement, much like your 1040 that you file with the IRS. Each year, every company in California is required to file this statement for every distinct physical business location that they have. You don't get to file a consolidated return on this. I know when you file your your business returns, if you have multiple locations, you can file a consolidated return with the IRS or the Franchise Tax Board. Not so with the business property statement. If you have 5 operations in California, you have to file 5 separate 571Ls. What do I have to declare on this 571L? Well, a company must declare on this statement all non-real property assets that are used in conducting its business that are not for resale. Essentially, your company's property, plant, and equipment. You're not going to include any inventory on there. That's for resale. You're not going to include the building, the walls, tenant improvement. That falls under the real property. But basically, anything that's used in in the conduct of your business. If you're a manufacturing company, all the machinery used in the manufacturing process has to be reported. The desks that you're sitting at right now, the computer, all of that stuff will be reported on your Form 571L for each individual location. Now, once they're reported, these assets are assigned a value based on their original cost and are given a declining value each year based on the assessor's definition of useful life. And I've highlighted that and put it in italics because this is going to be one of the main points and one of the main areas where we see the companies are being overassessed. So if you have a pen and paper, I want you to just go ahead and write that down and highlight it because that is going to be a key point in all of this discussion today. Again, continuing on, what is a Form 571L? The business property tax you pay is an ad valorem tax, which is Latin for based on value. When you file your IRS tax return or you file your franchise tax board, your income is based. The tax you pay is based on how much income you make. In a business property statement, it's based on the value of the property, and that's the value is what's determined by your respective county assessor's office. Once a value is determined by your respective county assessor, a tax rate is applied, and this determines the amount of business property taxes that you pay every year. So if you have $1 million of equipment, you send that in, and they're going to apply a tax rate to that. The tax rate varies from county to county, but will approximate about 1.11% of the assessor's value. And again, that changes every year. The base rate is 1%, and then there's some county mandated taxes that are tacked on top of that. But for budget purposes, if you use 1.11%, you would be pretty darn close to figuring out what your property taxes would be for the years. Okay, now that we've looked at the basics of what a 571L is, we want to look at why we're being overassessed. Well, and again, this is in our opinion based on our years of research. In our opinion, the 30-plus assessors' offices in California apply a one-size-fits-all approach to all businesses in California. When determining the useful life of business assets, the assessors use broad-based categories with long lives without any regard to the nature of your business. We're going to discuss that in just a little bit further detail here. As I look down at the attendee list, I see a lot of people that are from different industries, and everybody has a different business model, and everything works differently for them. And again, the county assessor doesn't take this into account. But let's look at it, as most of us are accountants here on the call. And we're going to look at this as GAAP or generally accepted accounting principles versus property tax. Under generally accepted accounting principles, when you purchase machinery and equipment or anything else used in the process, you, as the business owner, determine what the useful life of those assets are, and you would depreciate those assets accordingly. If you buy a $10,000 machine and you think it's going to last 5 years, you depreciate it to $2,000 a year, and that's it. You make that decision based on your business model. The assessor's office doesn't take this approach. They simply put all machinery and equipment into a 12-year or longer life category. And this is just one example, and we're just going to use machinery and equipment, but it could be for any number of things. But again, without regards to your business, they put it into that life category for you. So if you have machinery and equipment that only has a 4-year life, that means it's going to be obsolete, it's going to be not being able to use it in 4 years. That means you're going to be paying business property tax on this asset at a much higher rate than if it was properly classified as a 4-year life asset. Now, if you think about this, and again, we're going to get to some real-life examples here in just a minute. If you're a biotech company and you're going to go out and you're going to expend, let's pick a number, any number, $5 million for a phase, let's say phase 2 clinical trial. Now, you think that phase 2 clinical trial is going to last you 4 to 5 years. On your books, you would depreciate all of those assets over 4 or 5 years, whatever you came up with the life for those. You wouldn't depreciate them out over 12. You'd depreciate them out over 4 to 5. The assessor's office is not going to do that. They're going to keep their values relatively high, and they're going to give it a 12-year life, and we'll see where that comes in just a minute here. Okay, again, to stay with why you're being overassessed, when you're preparing your periodic financial statements, a company will determine its own depreciation expense. Even when filing income tax returns, companies determine their own depreciation expense. We have makers and we have acres, and there are guidelines as to which categories you put those in, but you're the one that goes through and you determine what your depreciation expense is. So there's a lot of transparency there. When you file your other tax returns, you see what your depreciation expense is. You know what it is. When submitting their 571Ls, companies only report the amount of assets on hand from the individual years that they were purchased. The assessor makes all of the calculations as to assessed value, determines the tax, and sends out bills without any input or review from the companies submitting their forms. I mean, if you think about that, would you let the IRS do your depreciation for you? No, I don't think so. I mean, there's got to be some transparency here, and this is where the big problem, in our opinion, lies with the methodology that the county assessor's office uses. There's no transparency. You don't have an input in making sure the calculations that they're doing are correct and they're in line with your business model. And I will give you a quick example. We had a company here in San Diego that came under audit, and we assisted them with the audit and got involved with the county assessor. And as we went through, we looked down, and they had over $13 million in machinery and equipment. And the assessor, over the last 4 years, and we'll talk about audits later in the webinar today, had put these all into a 12-year categories. Well, as we were going through the PP&E records and we looked at this, we started examining the business model of this company. And what we found was that they'd expended about $13 million, and most of it, without going into a lot of details, was for customer-specific projects. And there was infrastructure that they had to put in place to host their customers' needs. Well, the reality of it is that the contracts with the customers were only about 2.5 years old, and about 50% of them had a 2.5-year renewal. So the reality of it is that the life of these assets was going to last at the longest 4 years. 4 years, but yet the assessor had put them into a 12-year category, and since there's no transparency on that, the company didn't know, and they were paying at a much higher rate. And we're going to show you the impact of this here in just a minute. Okay, now, so we've talked about what's on a Form 571L. Where we see the biggest problem is the lack of transparency and the lack of input that companies in California have when submitting their Form 571L in presenting what their business model is. So let's put some real-world examples to this. And again, we're only going to take the one category of machinery and equipment. But here's an example of $1 million machinery and equipment that is misclassified by the assessor's office would mean to your company over the life of the asset. Okay, we have a table here that basically resembles what the tables that the county assessor uses to determine what your tax is. And again, this is just assuming that we had $1 million in machinery and equipment, and we're going to assume that we bought that in the year 2000, and they're going to assign a declining value, or what they call full cash value. So in the year 2000, if you bought $1 million of equipment, they're going to assume that something, that it does depreciate and there's a lack of value that comes on. So they're going to charge you, they're going to assess the value at that at 91% or $910,000. And at a tax rate of 1.11%, in the first year you're going to pay $10,000 on that machinery. Okay, that's fine. Now, if we look down and we said, no, this should actually be in a 4-year life, if we go back to our biotech example, again in 2000, we're going to put $1 million on our books, but instead of determining that the assessed value should be 91%, they're going to charge it 75 or $750,000, the same applicable tax rate. You're going to pay about excuse me, about $8,300. Not that big a difference in the first year. I got that. But if you continue to look down through the first 4 years, on the 12-year life, we get 83%, 76, 68, and 59. And there are some timing differences there, which is why we went down 5 years. But we can talk about that at a later time. So over the first 4 years, you're going to pay about $41,000 in business property taxes on this $1 million in machinery and equipment. But if you went down and we properly classified this as a 4-year life category, we're going to go not at 91, but we're going to go to 75, and we're going to go relatively quickly down to 53, 33, 18. Well, in the 5th year, we're going to be down, and we're going to be paying at 9%. They don't fully depreciate or fully charge off the asset. They're going to continue, as long as you keep it on the books, they're going to continue to keep that there. So over the first 4 years, just by classifying the assets correctly, you're only going to pay about $20,000. About $20,000 over the first 4 years. Now, that is a savings that goes directly to your bottom line of almost $21,000. And this is not a timing difference, folks. That's just additional taxes that you pay. It's not, oh, I'm going to get a lower tax rate later. A lot of times when you do with accelerated depreciation and things like that, that's not going to happen here. That's true money that went out of your pocket. So let's presume for whatever reason you kept the machinery and equipment on your books, didn't write it off, maybe just didn't get around to it. And I know PP&E is not the greatest, or is not the most the category on your financial statements that gets the most attention because it is pretty straightforward. But let's assume that it was all written off on your books, so your balance sheet, there's no impact to your balance sheet. The net is zero. It's all depreciated. It's no effect on your P&L. So you just don't get it off the books for whatever reason. They're still going to continue to charge the county assessor is still going to continue to charge that. And as you go down the years, as you look up here, it's 52, 44, 37%. Well, in reality, if you'd have gotten into the right life category, at least we would have only been paying 9%. Total cost associated with that over, let's just say 7 years before you got around to cleaning it up or disposed of the assets, is $56,000. If we'd have just gotten it into the right category, we'd have paid just a little bit over $23,000. Again, a 7-year savings on $1 million in equipment is almost $33,000. That's a lot of money. Now, this is on $1 million. If you're a company that has, let's say, $10 million in machinery and equipment, let's extrapolate out our savings. Our savings just in the first 4 years alone on $10 million in machinery and equipment that you've got is, $210,000. $210,000 over 4 years could go a long way to funding a lot of things. And that's real cash, folks. That's cash out of your pocket. That's not a non-cash entry. That's real cash. So that's what it looks like. And again, this is just on $1 million, and this is just taking one category, which is machinery and equipment, which we see as the biggest one right there. So I'm going to erase all of my drawings. I feel like a little kid once in a while. I like these things. So, and we're going to go back to our example here. So that just gives you a real-world example of one category that can save you quite a bit of money. Now, is it just misclassifications are the other reasons that you're being overassessed? No, there's a number of other ones. Misclassifications just happens to be the biggest one that we see, and the biggest one that we have problems with because there's a lack of transparency on your part, and based on your business model, you have no you have no input into the process when the county assessor is determining your tax. So there's other reasons for overassessments. Ghost assets. What are ghost assets? Interesting term. The reality of the situation is, folks, is that, again, PP&E probably doesn't always get cleaned up. Doing a physical inventory of all your property and equipment probably isn't the most highest thing on your priority list. And sometimes things, once they get depreciated, sit there. We had a client that had gone through some acquisitions and done a number of other things, and we we started doing some work for them and represented them as part of an audit, and we started examining their records. And what we found was they had $6.5 million in assets that were acquired prior to 1994. They were all depreciated, no impact, no nothing. It just hadn't gotten a chance to write them off. $6.5 million. I mean, they had $100,000 literally in typewriters and 286 computers. So we went through and we started walking the building. We were like, do you have $100,000 in typewriters? We couldn't find a typewriter in the building, but it was $6.5 million, and they had left them on there, and they'd been paying taxes on those for, how many, 10 to 15 years during the audit, and we will get to that. We were able to go back and get a huge chunk back from them, but it was just assets that hadn't been written off. Additionally, there are certain industry exemptions. I'm not going to go through all of them. If you have any questions, please feel free to reach out to me on your industry, and if there are any exceptions there, just throw a couple out there. We've got the movie industry has some huge exemptions for any business property that's used in there that's not accessible that people don't know about. The wine industry it has huge exemptions. So there are certain asset classifications that are exempt as well. Capitalized software. If you're a manufacturer and you have software that's used that you created within that machinery and equipment that you sell with it, that's not something that should be that's accessible. It should be pulled out and it's non-accessible. Solar industry has huge exemptions as well. The last one that I do want to comment on is obsolescence, because I do get this question quite a bit. We live in a fast-moving technological world. There are certain industries where people had invested heavily for whatever reason. The printing industry comes to mind right now, where people had laid out a lot of money, and with the advent of digital printing and what have you, a lot of those machines have gone from $4 to $5 million now to next to nothing. So if you have certain property and equipment that, based on technology advances or whatever reason, that's obsolete, we can, if there's a true obsolescence issue there, we can go back and we can make an argument in front of the county assessor's office that is obsolete, and we can knock it down to its current value, and they'll start using its current value on there. So for any of you folks that are in a fast-moving industry, and obsolescence, it could be a key thing for you. And again, I don't want to spend too much time on it here today, but if you do think you have an obsolescence issue with your PP&E, it's something you should very look at very heavily. Okay, we've talked about the 571L. We've talked about how it's taxed, why you're being overassessed. Okay, so you're coming to me today and you're saying, Rob, I think I'm being overassessed. What can I do about this? Okay, well, you have two remedies. Each year, every taxpayer has the right to appeal before the County Appeals Board the assessed value of their business property. That's the good news. Bad news is appeals can take 18 to 24 months to complete. You file, and then they probably won't get to you about 18 months, but by law, the county assessor is required to hear your case within 24 months. So the process is long. Just some housekeeping here. Depending upon your county, the dates to file an appeal run from July 1st to November 30th. For most counties. Certain counties have a September 15th deadline. If you want to know what your deadline is, please feel free to reach out to me, and I'll let you know on that. When we file appeals for companies, especially the first time around, we always make sure we go back and we file 2-year appeals, because while this is only a yearly right, generally once we hear the first one heard, the second one will take care of itself. And again, I just want to remind people of that. Last thing, and we're down to the last slide. I'm going to try and keep them about 2 minutes over, so I am going to try and get this great. Audits. Second condition is an audit. Everybody hates audit. When I was a controller, I had audits by my outside auditors. I had audits from the IRS, Franchise Tax Board, sales tax, workers' comp. I hated them, and it was just going to end poorly in some way for me, and it was going to be a lot of work. We tend to think that this is the only audit where it can actually end up as a good thing for you, and I'm going to tell you why. So each year, every company in California with an assessed value on their business property in excess of $1 million is subject to an audit every 4 years of the Form 571Ls they have filed for those periods. So they're going to go back and they're going to look at all your 571Ls for the prior 4 years. Now, what this does is that an audit opens up all 4 years and allows the taxpayer to apply for refunds for all 4 years for misclassifications and errors. So if you haven't taken a hard look at your business property over the last number of years, or haven't gone under audit, and you are subject to one of these audits, This is a time, well, like if we take the appeal, for example, it's really only for 1 year. To the extent that there are misclassifications and errors, all 4 of those years come under audit, and they open up. So if we can go back in and fix all those misclassifications for errors for you and reduce the amount of taxes that you technically owed in those years, you get refunds in the terms of real dollars that come back to you for 4 years, as well as getting things corrected on a going forward basis. I always like to tell clients, even if your audit resulted in no charge from the county assessor, in our opinion, you should still, we like to use the term argue amounts, but we should still scrub those amounts, as you have this one-time only opportunity to go back 4 years and recapture these taxes already paid. Again, if you get a no change in an IRS audit, you're happy as all get out, and you should be happy on your business property statement. But again, this is a chance to go back and open it up and get money back for all 4 years and reset the assessed value on those assets that you already owned on a going forward basis. So just because you got a no change does not mean that you shouldn't continue to look at these things. And again, this is the last slide. I'm going to end this here real quickly, but excuse me, sorry about that. I've been talking for 25 minutes here. And people often ask me, well, what does the auditor do? Well, the reality of it is that the auditors, when they come out, they're looking for compliance. They're looking for compliance with the rules and regulations. They're going to spend a lot of time looking for things like looking through your general ledger, making sure you capitalized everything, making sure that you didn't expense, a whole bunch of computers that you bought. They want to make sure that they get as many assets on the books from which they can assess value and generate tax revenue from. If they go through and see, they're not going to ask you questions like, so in machinery and equipment, what's the life of these assets? Well, it's 4 years. If they see them on there as 12 years, I can guarantee you that 99% of the time they are not going to make any corrections that are going to reduce your taxes. Let's say 98% of the time. They're simply there looking for compliance to get in and get out, either keep you at no change or find ways to increase your taxes. So just a little bit on that, and we can discuss that further. That's going to end the session here real quick, and we're going to get to question and answers. For further information on the Form 571Ls and how you can you avoid overpaying your business property tax again, please contact me. My contact information is right here. It's Rob Burden, Paramount Property Tax Appeal. My email address is r.burden@pptaxappeal.com. Our phone number is 858-225-1200, or visit us on the web at www.pptaxappeal.com. At this point in time, I'm going to open it up, and we're going to take questions and answers from the audience. And at this point in time, I'm going to bring Keith Jenkins on the line and to give us some of the questions that we've got. So, Keith, are you there, and can you go ahead?
Yeah, I'm here. Can you hear me?
Yeah, I'm here. Go ahead, Keith.
Okay, sorry about that. What does the appeal process consist of?
We do have Tom Bergerson on the line, and Tom, again, is our chief technical accountant, spent the last, it's been with us for a number of years now. Spent 27 years with the county assessor's office. I'm going to pass this over to Tom, and we're going to let Tom answer that question. Tom, you there?
Okay. Roughly, the appeal process involves, first of all, filing the appeal with the appropriate county, and as soon as I file the appeal, then I assemble information, usually contact a person who's going to be handling the appeal, and try to get some sort of resolution ahead of the hearing, assessment appeals hearing with the Assessment Appeals Board in the applicable county. Normally, though, this process takes about 18 months before I find anything out. So quite often I'm it's a waiting game. However, when we have an audit, that speeds things up considerably and can often resolve things within a matter of weeks instead of months.
Okay, thanks, Tom. We appreciate that. Keith, you want to give us the next question? Oops, sorry, Keith. Keith, can you go ahead and give us the next question?
Yeah, the next question is, once determination is made of reduced value, either on appeal or audit, how long till you get the cash?
That's always one of those questions that people want to know. Okay, we've got resolution. When am I going to see a check? Tom, you want to handle that one?
For some reason, yeah. For some reason, if it's easier to get a bill than it is to get a refund. But normally, they are getting the refunds out within about 45 to 60 days from the resolution of either the audit or the appeal.
Okay, so we're looking at about 2 months to actually get the cash back in the door.
Yeah.
Okay.
Absolutely.
Okay, thanks, Tom. Keith, you want to give us the next one?
Yeah, the next one is, how do I know if I'm overassessed?
That's a good question. I think, and I'm going to let Tom chip in here, part of there are two ways you can do this, and I know companies that will do this and will look at it on their own and will spend a lot of time looking at it. But the reality of it is we come in and can look at your records in a span of a couple days and give you an idea and compare that to what's on your Form 571Ls. And we can tell you in short order, again, within a couple days, whether you're overassessed or not. Would that be a fair statement, Tom?
Yeah, and also whenever you receive a tax bill, it does give an indication of what the value is, and I try to look at that for reasonableness, and usually there is something there that can be reduced.
Tom, just out of curiosity, percentage of companies in California you think are being overassessed?
I would say probably half of them are, maybe even more, but
okay.
There's usually something.
Good. Okay. Keith, I think we got time for one, maybe two more questions. You want to give us the next one?
Yeah. This question is, how often should you appeal?
Tom, you want to handle this one?
Yeah, well, I mean, as often, normally if we can get an appeal done, that will pretty much establish the value going forward. So once we've handled an appeal for the client, usually that will carry forward forever, basically. So once we've handled it, we might have to review it every once in a while, but you're usually good to go for the rest of the duration of your business.
So and again, I just want to go back because of the time frame. Just a reminder: the first year, if you've never filed an appeal before, again, it's going to take 18 to 24 months to get through the appeal process. So I would automatically go back and I would automatically refile the next year just to save yourself.
Yes, exactly. So let's say if we file one for 2013. We would probably file one for 2014 because they probably will not have heard the 2013 appeal.
Right, and we don't want to. And we don't want to miss we don't want to miss that year. But and then once you appeal it, you should just review it on a regular basis. Correct?
Yep. Mm-hmm.
Okay. Folks, because I did want to keep this to 30 minutes and I've gone just a couple over, I'm going to stop it at this point in time. If you have any further questions or comments, please feel free to reach out and touch base with me. You can ask for Tom Bergerson as well if you want to go right to the Chief Technical Accountant, but you do have all of my information here. I want to thank you all very much for being a part of this call, and hopefully it was informative for you. So again, thank you very much. Take a look at those property taxes, those business property taxes. Make sure you're not overpaying. And again, we appreciate you taking the time to sit through this, and we hope we were informative. Thank you very much.